1958 marked the beginning of an idea to bring about how one views and understands management and its potential for meaningful interaction. This led to the birth of Calcutta Management Association or CMA, with Sir Jahangir Gandhi, the then Director General of Tata Iron and Steel Company Limited, as the founder president. CMA today is a vibrant organization, as vibrant as the city it is located in. Affiliated to All India Management Association or IMA, the apex management body in the country, CMA today has a membership base of over 1,000, including nearly 100 corporates. True to its mission and vision to create a platform for the management community where contemporary management ideas can be conceptualized, formulated, developed and practiced, CMA over the years has organized a series of path-breaking meets, workshops, seminars, talks, interactive sessions and exchange programs. We at CMA have taken on the onus of covering a wide area from management education to management practice, with the objective of fostering and developing excellence in management, all to help profit the mind.
Yeah, Anirban.
Good evening. Yeah, I'll just start off the event. Just a minute. Good evening, ladies and gentlemen. We welcome you all to this CMA classrooms, the first of its kind, because we'll be having a special dignitaries today with a special classroom that we'll be taking off. This is the classroom on will be basically classroom on futures and commodity markets. We welcome amongst us the three dignitaries: Mr. Archan Barua, Mr. Sidharth Ganguly, and Mr. Vibhor Tandon, who is also the moderator of the event. I would introduce the speakers one by one. Mr. Archan Barua is a gold medalist MBA in agribusiness management with more than 15 years of corporate experience and a diversified experience across the commodity value chain. Archan has worked closely with the farm sector during his stint with Dow Chemicals, and for more than a decade has been a cotton trader at one of the largest commodity companies of the world, Cargill. In between, he has worked at NCDEX, where he has successfully listed cotton futures contracts. Archan is presently the business lead for Cargill's cotton business in India and is involved in trading and merchandising cotton in India, Pakistan, and Bangladesh. We welcome you amongst us, Mr. Barua. The next speaker with us today is Mr. Sidharth Ganguly. He graduated from St. Paul's Cathedral College under Calcutta University with physics honors, did PGDEM from IIS WBM, was associated with Indiabulls Securities Limited, Kolkata as Senior Vice President for almost 10 years, had worked with Veligare for 1.5 years, and has been associated with Narnolia Financial Services for last 7 years as Zonal Head. We welcome you, Mr. Ganguly. And finally, for the moderator, Mr. Vibhor Tandon, who is also the Assistant Treasurer of Calcutta Management Association. Mr. Tandon is presently Assistant Vice President at MCX India. He has more than 20 years of experience in financial markets. He has spoken in more than 600 seminars, workshops, and conferences. He is in the governing body of many associations and chambers and is presently, as I told you, the Assistant Treasurer of Calcutta Management Association. Before I request Mr. Tandon to please take over, may I just remind all the participants that you are all on mute. I would request, if possible, please also keep your webcams on off mode so that it is easier for us to, to visualize only our speakers and the moderator for the day. And also, I have put everyone on a mute mode other than the speakers and moderator, who can switch on and switch off their mute buttons. May I now request Mr. Tandon to please take over.
Well, good evening, everybody, and a very warm and hearty welcome on behalf of MCX Multi-Commodity Exchange and Calcutta Management Association on the occasion of this awareness program. And we have been doing in these programs across the country for educating investors and physical market participants. It is a very special evening to this time, a very special evening today, because we have two very eminent experts from different fields, and I will be glad to actually be part of this presentation, and after this it will be a small discussion as well, where we will be, both the panelists will be sharing their own experiences, their rich experiences from the industry itself. So, Anirban, do you have the slides? Can you go and
yes, sir. You keep on. I'll just share the slide. Just
okay. So, meanwhile, talking about the commodity futures market as such, well, some of you would be aware that when we are talking about the commodity futures markets, they are a part of the financial markets as such. If you look at the financial markets overall, there are different instruments which are traded in the markets. The most common, which most of you would have heard of, is the stock market, and almost everybody would have invested a penny at least, or maybe thousands or lakhs of rupees in the stock market as well. The second most common one is the bond market, where trading happens in bonds. The third one, which I'm talking about, is the commodity derivatives market, where trading happens in commodities in different times, and to be more specific, commodity derivatives. In addition to that, there are other markets, there are other instruments which are traded in these markets, such as the currency markets, which are also very big markets. Now, we talk about commodity markets. What exactly is traded in the commodity markets? To be very specific, what is traded in these commodity markets is not commodities per se, but commodity derivatives, which are traded in these markets. So these are contracts, which are standardized contracts, which are designed specifically for the purpose of different stakeholders, and after approval from the regulator, which is SEBI, they are launched in these markets. And what we trade in the markets are commodity derivatives. These derivatives are based on the underlying physical commodities, which may be gold or silver or crude or the different commodities which are there. The next slide, Anurudha. So if we broadly categorize the commodity market as such, there are two important classifications, or I would say two important parts of these commodity markets. The first important part is the spot market as such. And when I talk about the spot markets, we are talking about the physical markets, where physical trading of commodity happens, which is buying and selling of commodities happens physically. And the primary function is to enable availability of the commodity. This involves various value chain participants, such as producers, consumers, importers, exporters, and processors. Now we come to the second part, which is the derivatives market. And these derivatives markets largely are dependent on the underlying, which is the physical markets as such. They exist in parallel and enable physical market players to manage price risks. And here you have both exchange as well as the OTC, which is the over-the-counter markets, which are available. As I was mentioning, a derivative is a financial instrument where the price is derived on another asset, which is the underlying asset or the underlying physical market, or the underlying physical commodity, which may be gold or silver or any other commodity. The next slide. So as we have already discussed about the derivative contracts, this derivative contracts are primarily instruments which are designed pre-designed derivative contracts, which with a specific underlying commodity, where we have pre-decided delivery center, where there is a pre-decided expiry date on which this contract expires, and at the same time, this contract has a specific contract size and a quality specification based on which the trading happens. So if we talk about gold per se, it is only 99.5% purity of gold which is traded in these markets. If somebody brings in, let's say 90% purity of gold, that is not traded because there is a specific quality which is traded and there is a specific delivery center on the delivery on which the delivery happens. Additionally, these are the basic features of a standardized derivative contract. And when you want to trade in these markets, in any of these markets, you need to obviously open an account and pay a small amount of money to trade in these markets, which is known as a margin money, and by which we mean a token of amount of money which you pay as a security when you trade in these markets. The next slide, please. So before I get into the factors which affect the commodity markets, I would like to mention the two most important roles that a commodity market plays or a commodity exchange plays. These commodity derivatives play two very important roles. The first most important role that these commodity derivatives play is that they provide a robust, free and fair price discovery mechanism. The first most important function of commodity futures or commodity derivatives is price discovery. And by price discovery, we mean that the prices are discovered in the market itself by market participants. Not the regulators, not any institution, nor any other authority decides the prices. So you have thousands of buyers and sellers, buyers on one side of a commodity and thousands of sellers on the other side of the commodity. And they put in their bids for prices of the same commodity. So let's say that you have thousands of buyers who are trying to put in different prices of gold and thousands of sellers who are trying to put in different prices of gold. And if we talk about any other commodity, let's say you're talking about aluminum or zinc also, they are trying to put in their prices and quote their prices. Then on one particular price, let's say if the price of aluminum is 100 rupees and the 100 rupee at 100 rupee, the price of the buyer and seller is matched and the trade happens, the trade is executed. In such a scenario, the current price of the commodity becomes 100 rupees. And this is how price discovery happens in a free and fair mechanism, pan-India, electronically, where the price is decided by the market participants itself. The second most important function which this market plays, or commodity derivative plays, is that of risk management. Now, by risk, we talk of fluctuating prices, the fluctuating commodity prices. We are aware that all the commodity prices are fluctuating on a lifetime basis, in the sense that on a second-to-second basis, the prices of commodities keep changing. And thereby, any physical market participant which is exposed to or uses any commodity per se for its consumption or is a seller of any of the commodities, it is automatically linked to or exposed to the price fluctuation of that commodity. And this market enables these physical market participants to manage this risk by way of hedging on the commodity prices. So these are the two most important functions that an exchange plays in the commodity markets as such. Now, talking about different factors which for a number of commodities which are traded on the exchanges, we are aware that these commodities are internationally linked commodities and internationally referenceable prices are there. For example, if we talk about gold or silver or crude oil or any of the other metals as such, or any commodity, generally there is some amount of link or the other to the international commodity prices. Because in most of the cases, the largest markets of these commodities are based outside the country, such as the COMEX in the US, which is the commodity exchange in the US, which is the largest commodity exchange in the world. NYMEX, which is also part of the commodity exchange there. ICE, which is again based out of Europe. You have the Chinese commodity exchange, which is there. And most of the commodity prices that we see are simply a mirror replica of the international commodity prices, barring some of the commodity prices wherein we have a direct correlation with the local markets, as a matter of fact, because the final settlement of these commodities happens as per the local prices as such. So for the international commodities, definitely it is important to look at the international prices because they are directly related to the international prices. For the commodities where prices are domestically derived and the settlement of that particular commodity happens as per the local prices as well, it is a wise thing to look at the international prices because one of the components, prices of any commodity as such, domestic as well. So looking at the international prices, the second is forex rates, because by virtue of the fact they are actually related to the international markets, automatically the rate or the exchange rate or the rate of the currency, the forex rates just actually play a very decisive role in deciding the prices of these commodities. Thirdly, geopolitical factors. Whenever you see disturbances like war happening, disturbances like any kind of an earthquake happening, or this COVID, for that example, which is automatically has which these factors automatically have an impact on the prices of these commodities, because the most important factor which decides the price of these commodities, as mentioned in the last point, is demand and supply. And either of these factors which we have discussed about actually affect the demand or supply scenario. Of course, in addition to that, there are other factors like economic factors, which is economic conditions like recession, inflation, the kind of growth rate which is there in the international markets, because it largely affects the demand and the supply scenario. Like when we saw in case of COVID, in case of such a scenario where the entire world was affected by COVID, both the demand side and the supply side was affected. The next slide, Anurag. So what exactly is the commodity price risk? I'll basically just give a reference to it, and then we'll leave it because we have a discussion in the later part of it. You can move on to the next slide, Anurag. Okay, talking about price risk, as I was mentioning, that the price at which the physical market participants buys or sells a commodity is largely depending on the price of the commodity which his own business is related to, or her own business is related to. So let's say it's a jeweler, then he's directly exposed to the fluctuation in the prices of gold. And if he is a cable, he's automatically exposed to the prices of aluminum, which is basically a raw material for itself, for its own commodities, for its own products. And thereby, this is the risk which exists for any of these physical market participants, wherein their material prices, if they increase, they pose a risk to their profit margins. And in case they are sellers, then the finished product prices, if they come down, they pose a risk because they again eat into the profit margins. So what is hedging in very simple terms? Hedging or hedgers, we talk about who are the hedgers? The hedgers are the different participants who are exposed to the physical markets, who are actually part of the physical markets and are actually having a direct correlation with the commodities and thereby exposed to the commodity price risk. These hedgers include the corporates, the farmers, the producers, the consumers, the importers. In fact, the entire value chain is basically what constitutes the entire hedger community. And they transfer the risk to the investors, which are again a very, very important part of the commodity markets. So if we break down, or if we look at the two different and the most critical stakeholders of these commodity markets, one is the physical market participants, and the second, of course, is the speculators and investors who constitute these markets and who provide liquidity to these markets. And this market is able to serve both. Well, I'm over with my slides now. I will now come on to the discussion, and Anirban can probably remove the slides. Now we can, I would first, we have people We have experts from different domains here. And when I talk about experts, we have Mr. Archan Barua, who's part of the physical market community. And he is, in fact, a representative of the hedgers community. We have Mr. Sidharth Ganguly, who is part of a capital market advisory organization. And he heads one of the divisions. And he effectively and importantly represents the community of investors and traders. So I'll come to Mr. Archan Barua first. And I would request Mr. Archan Barua to share his views. I think everyone, you can remove the slides. We don't need the slides anymore. And I would request Mr. Archan Barua now. Mr. Archan Barua can unmute his audio. And I would request him to mention a bit about the commodity price risk. How important is the commodity derivatives market for physical market participants and corporates? So you can share probably a few lines about it.
Yeah, so, first of all, thank you to CMA and Mr. Tandon for having me on this webinar. It's always good to interact with people across the chain, across industries. Coming back on your questions, I think for a company like ours, which is principally into commodity trading, or anybody who has an exposure with the physical commodity, so anybody who buys, consumes, transports, or processes the commodity, he is exposed to price risk. Now, before I get to that, I would just like to share for the participants here that most of the word commodity by itself means anything which is non-distinguishable. So you cannot distinguish it on the basis of brand or on the basis of attributes, etc. Wheat is wheat. The wheat that you can buy and the wheat that I can buy, wheat that anybody else sells, is all the same. So there is no value proposition when you buy from me versus when you buy from somebody else. Now, when you don't have a value proposition, you don't have a brand margin, your margins are very thin. Most of the commodity trading companies work on less than, I would say, 5% margin. And any commodity price, if you take, annualized, will have something between 8 to 30%, fluctuation in a year. So the price risk is so huge that it can wipe away your entire profits, and probably it will make it difficult for you to survive. And as the world economy is opening up, this is becoming more and more difficult for companies to, just operate without a price risk tool. So for anybody who is exposed to this risk, I think the commodities exchanges are an absolute essential. We actively do this as a part of our daily, bread and butter job. And the commodity exchanges serve three main purposes. First is obviously this price risk, where we talk about hedging. I kind of mitigate my price risk by participating on the exchange. Maybe we can talk about it a little later. The second thing that the exchange gives us is an idea about the price. When we deal with wheat, cotton, gold, silver, we don't know what is the price going to be in the month of December 2020, what is going to be the price in March 2021. But we cannot stop our operations. We have sales, there are manufacturing industries who are running, and they are taking orders, they are processing. They need to have an idea whether the price in December is going to be X or Y. The only place you can look at it is a commodity exchange, because it trades the future price of a commodity. Based on that, you can plan your pricing, you can plan your production. The third thing is, if you anticipate that 6 months from now, there is going to be a drought in the country, you may not have enough wheat, and you are a biscuit manufacturer who needs to buy wheat. So you know that the price will go up. What can you do? That's the only place where you can protect yourself. It's like buying an insurance. So you go to the exchange, you take a position on the exchange, which helps mitigate against this price risk. And the last thing, I think, what I would point out for an exchange, which doesn't get spoken about as much, like the price discovery or the risk mitigation, is the counterparty risk. When you take a position on an exchange, you virtually have zero counterparty risk. In India, the commodity trade is not very regulated. It's very, very fragmented. You have suppliers here who are basically just a step up from a farmer. So you can understand how unregulated that sector is. You buy from those people, and if the market prices move 10, 15%, or even 5%, they are not in a position to deliver the goods to you. And then as a company, you run this huge risk of counterparties. So instead of going and just actively buying from people with whom you cannot take that kind of a physical risk, you basically tend to take your position on the exchange. The exchange guarantees that on the day of settlement, whatever be the price, you will be paid for that. I think these are the three main things that I would suggest on a basic level everybody should look at an exchange. I think Mr. Tandon, you're on mute.
Thank you, Archan. You beautifully mentioned about the counterparty risk, which is again a very, very important function of any exchange as such. And in a kind of market such as India, where this is probably the biggest risk that any trader or any businessman would actually be facing, this is very important to understand a very important risk, which is yourself been into these markets and yourself been into the physical market participants as such, and you have been into risk management. So what would be the right way, or I would say what would be the right modus operandi to manage the risk for different market participants who can be either on the demand side or the supply side? So I would request you to mention, in case somebody is a buyer in the commodity markets, or if somebody is on the seller on the commodity markets, on the selling side of the commodity cycle, how is it possible for them to mitigate or manage the risk by or through commodity derivatives?
Right. So, we talk about price risk now. So before I get to that, let's very briefly understand that we are talking about hedgers here. So the hedging by itself, the definition is your main aim as a hedger is to protect the value of your underlying by taking an offsetting position on the exchange. Now I'll explain that word by word, but what I want to differentiate here is that you're not trying to make money out of your position on the exchange. You're trying to protect the value of the underlying. So let's talk about a very real example that the cotton industry faced. So I have been working in that industry, so I'll give you an example that we have come across. So January, pre-COVID, the cotton was trading at a price, and today, as we get out of the lockdown, the price has dropped by 18%. So whatever was the price of cotton in January, today it is 18% lower. It's simply because there is demand destruction. For 2 months, people are not buying clothes. Nobody is getting out of the house. So all those reasons are there. So your commodity price is 18% down. Anybody who was owning cotton in January, today has an 18% loss in his portfolio. It's not coincidental that the futures price on MCX cotton has also dropped 18% from January till today. So if you had a opposite position on the exchange, the 18% loss on your cotton value would have been offset by an 18% gain on the returns that you would have got from MCX. That's just one example. Now, let me give you another example of how you would hedge. Let's say, again, I am a biscuit manufacturer and I need to plan my production. And for that, I need to know the price of wheat in the month of December. So I go to the exchange. I see that wheat is trading at 2,000 rupees per metric ton for December. And I think that if I buy at this price, adding all my overheads, production cost, etc., that should give me a reasonable margin. So as a company, I would like to buy wheat at 2,000 rupees a metric ton. but I can't do anything about it because between now and December, there is nobody who will sell me wheat. Nobody, and even if I buy, I run this counterparty risk that if the price goes to 25,000 or 2,500, this guy may not even deliver to me. So what I do is I go and buy, let's say my requirement is 100 tons of wheat. So I go and buy 100 tons of December futures at the trading price of 2,000 rupees a ton. So let's say this, we now reach December, and the actual price of wheat in the country is what you anticipated. It has gone to 2,400 rupees a ton. So it's gone up by 400 rupees over where you are comfortable buying wheat, but you don't have an option. So what do? You have to buy wheat at 2,400. So you pay 2,400. But then now look at the position that you have on the exchange. You bought 100 tons of wheat at 2,000 rupees, which today should be worth 2,400 because the futures market reflect your cash market. As the cash market is trading at 2,400, the futures market for December will trade very close to the cash. Otherwise, you will not have this convergence. So the wheat that you bought at 2,000, you earned 400 rupees per metric ton out of that. You paid 2,400 to your supplier. So effectively, you paid 2,000. Now, by doing this, the company or the procurement manager or whoever is it, he has ensured that the company has locked in this price of 2,000 rupees per metric ton for December, and then there is no erosion of the margin that they have planned. So this is just a very basic example of how you would, hedge if you were a consumer or a long side hedge.
Thank you so much, Archan. You gave a beautiful example and beautifully explained the entire process, how hedging happens for different market participants. Now, I would, request an important stakeholder representative which we have, which is Mr. Sidharth Ganguly, who is representing the community of investors and traders. And I will request him to probably share a few words on why it is important for the investors community, for the investors and traders to participate in the commodity markets. Mr. Ganguly, please.
First, I would like to thank CMA and or Mr. Tandon for inviting me in this webinar. Commodity is important just because one investor, when they are investing in the market, they should have the proper asset allocation plans depending on their risk appetite and their age. If their age is maybe one guy is at 40 years old, so he should have a allocation of equity maybe or 60%, and 30% should be your debt, and 10% should be your gold. We are not recommending real estate right now just because we are not finding your sustainable growth in the real estate sector. But in commodity, we are recommending gold. It can be like in this situation where the IMF is predicting the world economy, world GDP can go down to your -3%. And this kind of economy situation helps the gold to go up because it's a self haven asset class. Moreover, the central banks are cutting the rate, already have cut the rates and may reduce further. Third point is, if you see the real interest rate across the globe is either low or maybe negative. So we have seen there is a negative correlation between the real your interest rate and the gold prices. So gold prices have already gone up maybe or 49%, I believe, in last 1.5 years. So it can go up further depending on this situation. There is only two threats we are finding in gold. Like central bank has already bought 650 tons gold in 2019, and if the central bank starts selling to support the economy, there can be maybe it can stop that rally in the gold. But I mean, it's not stopping the rally, but
yeah, I'll just interrupt. Sorry, Mr. Sidharth Ganguly. You beautifully explained about the particular commodity which is important to be invested, which is gold. So you mean to say that a very important aspect of this entire market as such for investors is diversification? Huh? That is what you're
Of
trying to
course,
say.
there's
That
a proper
every investor should have a
asset
diversification.
allocation.
Yes, asset
Asset
allocation and
allocation has to be there.
diversification.
Yes. So because
Yes. Thank you
if
so
someone
much.
yes,
Tell me, please.
if
If
someone
someone
had
has, you're saying
invested
something.
in the gold, maybe in 2019, they could have, like, equity has fallen down. Equity has corrected almost your 40, 50, 45% from the top. So there can be a good your maybe your support if they have already invested in the gold. So we always suggest to invest in the gold or like the precious metals.
Okay. So yeah, correct. So asset allocation is a strategy or diversification is a strategy which you are always suggesting.
Right.
Thank you so much, Mr. Ganguly. Now there's one more question which I wanted to ask. If there is an investor, and this investor or trader who wants to participate in these markets, uh, any of these markets and more so commodity markets, then what are the things which he should look at? Like in the sense that he should, probably some people say that there are opportunities available where they can trade even without investing any margins, without opening an account. So would you suggest that to the entire investors, or would you suggest the other way around? So I would just request you to
See,
probably mention about it.
firstly, you should open an account with the registered broker. Number one, you
Yes.
should not
Okay.
depend on any or trader or maybe dabba trader, what we actually call. And number two is like in commodity markets, if someone wants to invest, he should know his risk factor, the how much he wants to invest in the market, and what risks he can take, what the loss he can take. Because in commodity market or on future market, you are paying your maybe 10%, 20% as a margin. So don't be over leveraged. Number one. Number two, don't take too many risks. And if you are trading, if your mentality is to trade in the market, you should maintain the stop loss in the commodity or maybe
Thank
any
you
segment,
so
any
much.
future segment.
Thank you. So you maintained all the risk factors which are there. You also mentioned that you should be opening your account only with the registered entity. And at the same time, you talked about not being over invested in any market, but depending upon your capacity, you should be slowly increasing your risk. So I'll now get back to Mr. Barua. Mr. Barua, you can probably unmute your video and audio.
Yeah.
And I'll request you, Mr. Barua, to probably, in case you have anything else to share or any suggestions or any thing with you which you would like to put forward as suggestions or recommendation to the overall market participants or to the stakeholders, then you can probably share in 2 or 3 minutes, and then I'll move on again to Mr. Sidharth.
Yeah. So, very briefly, I think I don't want to get too much into retail investor side, but what I would point out is one of the reasons why the commodity market has not picked up is because it's not been properly represented to the retail investors. People know so much about equities, they don't know, or they don't have an opportunity to know commodities. And that's mainly because the type of products that we have today, except for a gold ETF, you don't have any product in which a retail investor can invest. The other option is you hold the physical commodity and earn interest on that or earn carry on that, which all the time will not happen. So I think without getting those investors or the retail investors or large corporate investors, the commodity markets will not develop, because on your slide you very clearly mentioned that the hedgers are actually transferring the risk to these investors. So unless we have the investors, people like us cannot participate on the exchange. So one of the main challenges we face on the exchange is the lack of liquidity and depth. For example, today you can buy 1,000 shares of Reliance at a single price and get out of it at a single price. For me to buy even 10 bales of cotton at a single price is difficult at MCX, because there's just not enough market participants. And unless you get both the sectors together, you cannot develop that. I think a lot of the good developments are happening over the last 2 to 3 years. I don't think we should look at it pessimistically. This sector is just starting. In a few months, we will have banks, we will have mutual funds who will start, allocating a portion of their products into commodities. Today they do either on equity or on the bond market, but then they will also start allocating to equities. So you will have some participation. We recently have this the non-agri commodities where the government has started emphasizing that they should be delivery based. Now in the short term it can take away some of your participants, but look at it the larger picture, that the bigger corporate houses who are based in India, they will start participating on your in your non-agriculture commodities. So that's a very good, I think, development which is happening. On the agriculture sector, the government has come out with this APMC Act regulation. It's kind of making India as one market finally. If you are based in Tamil Nadu and the commodity is being delivered in Gujarat, 3 years ago you could not have even done anything. Today it doesn't matter where you're located. You can trade the physical commodity wherever it is. So all these things, these are all good developments. Lastly, the government is also allowing your eligible foreign entities to enter. So our counterparts, companies like us who buy and trade from India but don't have a physical presence in India, they are located outside India, even they can start participating in Indian commodity exchanges. So I think these are all good developments. It'll take some time. What I hope from the regulator and from people like you from the exchange is that your main focus should be on developing investor confidence. What happened a couple of years ago with the NACL, I think those type of things pulls back, the confidence of the corporates as well as individual investors. So investor education and investor confidence, if that can be invested in, and along with all these regulatory changes, I think it's a great time for people like us, to be there. And before our time is over, we will see a lot of positive changes that would have happened.
Thank you so much, Mr. Barua, for your insights. Just to share a little bit more, there were a couple of good developments which happened over in the recent past. We now have options which are traded on these markets. Over the last 2 years, we have seen the advent of options, and we have good participation coming in options in different commodities such as gold and silver, on the metals front as well as on the crude front. So options is an instrument which was basically a part of a long-time demand, a long-term demand from different market stakeholders such as physical participants as well, who have this opportunity now to trade or hedge the risk through options, and at the same time, even for the smaller investors or retail investors who were looking forward to restricting their risk even while investing in commodities, they were looking at options, and now options are available. To add to it, we have had this opportunity where markets have been opened up, and now we have the bank subsidiaries which are allowed to participate in commodities. The regulator has allowed banks to participate. The bank brokers are all participating in these markets. We have the broker has in a selected way allowed mutual funds to participate in the commodities. We already had category 3 alternative investment funds which was participating in these markets. They could run schemes which are similar to those of portfolio managers, and they could run these funds. They were already participating in these markets, category 3 investor in 3 AIF funds, which is alternative investment funds. And now mutual funds are devising products to participate in these markets. So we look forward to the liquidity and the participation of different stakeholders to go multifold in the coming few months or coming few years. With this, we also have a number of good products which are coming in. We look forward to the introduction of indices, since the regulator has given us permission to launch indices. And the first one we should be launching is the bullion index, which will again go a long way in developing these markets while allowing the investors to participate in the index as well. So with this, I would like to now come to Mr. Ganguly, in case you have anything to share or any suggestion for investors, any last suggestion for investors. Of course, we are doing this program jointly with IPF, so there is no suggestion that we give on prices as such. But if you have anything which you want to suggest to investors, like you already done that, or any suggestion to the exchanges or regulators, you can share that and then we can do it. Mr. Ganguly.
Suggestion for the investor, like first I would like to say the market will be volatile for next maybe 6 to 12 months, and it will depends on the news inflows. But the investors should have the patience. Investors should invest in this such your slow growing economy as well. And as I told, like they should have the proper plan of asset allocations according to their risk and the age. And secondly, if anyone has the disposal liquidity, like liquidity in disposal, he should invest in staggered way, maybe in 6 to 12 months. Thirdly, I suggest all the investors to check the quality of the stocks they are having, because it's very important right now, because I don't know, because any the research house, maybe advisors don't know what will happen after 6 to 12 months time, when we'll get out of this pandemic situation. So you should already, market has already corrected, and the quality stocks are trading at cheaper rate, so you can switch your stocks to the your quality stocks. So I will suggest all the investors to screen your portfolio and diagnosis your portfolio, the imbalances in the portfolios, and most importantly, check the returns of the portfolio. Like if the market has come down from the Nifty has come down from the 12,400 to now 10,000 level, what was the portfolio value at that time and what is the portfolio value at this time? So you can actually check what's the return you are getting. So if there is any imbalances, if you see that many Nifty has corrected 40-50% and your portfolio has corrected 60-70%, so there is some imbalances in your portfolio, you should check and your realign to the safer asset.
Thank you so much, Mr. Ganguly. You have very nicely given a very clear-cut idea to the investors and participants by mentioning that they should invest based on their risk appetite. They should be looking at the overall picture and the macro picture investor instead of looking at the micro picture when they're investing. And at the same time, they keep checking. They should be, most of the times, they should keep an eye on their portfolio as such. So that was very nicely explained. And now, in case there are any questions, so I see only 1 or 2 questions there, which are, because I believe most of the questions have been answered in the discussion itself. So somebody was asking about the impact of COVID on these markets and what one should do. So the impact of COVID was clearly that, I would like to answer that question myself. It was very simple, that looking at from the macro perspective, both the demand and the supply side was impacted due to COVID, wherein demand was comparatively lower by virtue of the fact that the entire, almost a large number of constituents of the economy across the world, they were not operating. And therefore, the response or the demand side was slightly muted. At the same time, there were supply constraints because there were logistical issues, and the transportation side was also impacted due to COVID. Well, now after the last, therefore we saw some volatility, an unexpected volatility in some commodities also due to the same. Like we saw that in crude, because there were logistic issues, storage issues, and demand was not there to that extent. Therefore, we saw there was a huge spike and there was a lot of volatility in the prices. And by virtue of the fact that we have seen the entire world, almost all the entire economy opening up in the last 15 days, we have seen good participation coming in. Now, to tell you a little bit about the markets, if you look at the markets, commodity markets as well as capital markets, we have not seen participation fall from the perspective of investors or retail participants. Rather, we have seen new accounts, lakhs and lakhs of new accounts opening every month for the last 3 months, probably because people have had more time to, look at their personal investment portfolios, and people have taken a lot of interest here. And we expect a lot of participation coming in going forward, both from the physical market participants as well as the retail side or the investors as such. With this, we come to the end of this session. And it was a good 1 hour, 10 minutes discussion that we had, this presentation that we had. I'm sure this would have gone a long way to improve the understanding of the participants about the commodity markets as such, the commodity derivatives industry as such, how they should look at the commodity derivative industry, the way different stakeholders should approach commodities trading, what are the benefits that they get from these trading, from these markets. Mr. Archan Barua very beautifully shared about the different benefits that the physical market participants and corporates can extract from these markets, and how they can actually hedge their risk in these markets, and which went a long way in making people understand about the physical side of these markets. Mr. Sidharth Ganguly very nicely and very shortly explained about how investors should approach the commodity markets and they should look at it from the point of view of asset allocation, risk diversification, and they should come to these markets, but with the preparation, after understanding the risks in these markets, and they should always be under-invested in these markets rather than being over-invested in any market as such. And of course, I started off the session by giving an overview and a basic understanding of the commodity futures markets. So with this, we have come to the end of this session. I think it was a very nice session, and I am extremely thankful to both our panelists, which was Mr. Archan Barua and Mr. Sidharth Ganguly, who have given their insights and shared, the various insights on the commodity markets from different perspectives. I also am thankful to the entire segment, or I would say all the participants. I can see more than 60, 70 participants who are there. A good number of participants who are there. I would thank all of them for participating in this wonderful session and making it successful. At the same time, I would be, on behalf of Calcutta Management Association, I would be thanking, the different stakeholders or different participants who have made possible, ensured the success of this program, like the Investor Protection Fund, MCX, and also the two panelists who have done beautifully well in, ensuring that the investors or the traders and the participants go back with a very clear-cut understanding of these markets. And last but not the least, I'm thankful to all the participants who have given their valuable time and participated in this session. And to make this session successful, they have given their full cooperation. With this, I think we come to the end of this program, and we look forward to this program, this kind of sessions once again. Thank you very much, everybody, and we look forward to meet up soon in a different session. Thank you so much.
Thanks a lot. Thanks.
Thank you, Mr. Tandon.